conversation forward. Let's try and understand what does he make of this sudden shake in the market. It's a 10% correction. It's not a large correction, but a 10% correction is something we've not seen in this bull market. So that is slightly different from what we are accustomed to. So Nilesh, let me divide the market in just 3 words: buy, sell and hold. Considering the current market right now we are in, how would you divide the market into what is in the buy zone, what is in the sell zone and what is in the hold zone? It's a simple question, Nilesh, but this simple question perhaps captures everything.
Yeah, Nikunj, as they say, some of the most simple things are the most difficult things. But nevertheless, look, Nikunj, I clearly believe that, this continues to be a buy on dips market. Clearly, we've seen that there's been a steep price correction in several sectors, several stocks, and they become even more attractive post this round of correction. We still believers that it's going to be business as usual, life as usual. We clearly believe that some of the sectors, some of the businesses around consumer and around unlocking, and some of the businesses powered by digitization and the internet are going to basically continue to thrive in this kind of an environment. In addition to that, businesses which I would associate with socializing, which is essentially the alcoholic beverages space, the foodstuffs and snacks, those kind of categories again look very attractive. One interesting sector which has caught our attention in recent times has been the media space, the news broadcasting space, and that's where some of our recent addition has been. So clearly lots of sectors, lots of businesses have come into the buy zone. In terms of sell zone, though we don't own any of these, but one has to essentially keep in mind that metals probably have run their course. They may give you a bit of trading rallies here and there, but don't see any kind of a material upside. I mean, metals, of course, have done extremely well, especially the ferrous space has done extremely well. Clearly believe that continues to be sell, especially for somebody who's running more an investment kind of style. In terms of hold, clearly believe that the technology space has kind of in a way appreciated quite well. A lot of the IT services companies, the tier 2 IT services companies, I probably think that they're more a hold now rather than an aggressive buy.
Is this current leg of decline, 10% on the index, 15-20% in individual stocks, is this decline which you've been waiting for? Because let's say in the month of November, in and around Diwali, the concern was the market had reached elevated level. Stock prices were reaching what could be called as overbought and price to perfection zone. I mean, mid caps had almost become Humpty Dumptys.
Yeah, absolutely, totally. And while the indices have corrected, maybe in high single digit, maybe at best 10%. Clearly, individual stocks have corrected quite a bit, and you could call this as a bit of some players or some investors getting into basically a risk-off mode and things of that kind, or concerns around the latest variant of the virus, or maybe even concerns around rate hikes and the taper. The concerns have been multiple, and clearly we believe that these are not concerns which are in a way are going to materially impact the fundamentals. Still continue to believe that we would be able to deal with whatever the next round of the virus. Continue to believe that the interest rate environment, at least in India, will continue to be benign. And overall, clearly continuing to see strong demand across both pockets of urban India as well as rural India. Monsoons have been good. Rural economy has been strong. So on the whole, in addition to that, of course, on the urban side, we're seeing very strong hiring by companies, wage hikes happening, salary hikes happening. So across the board, what we are seeing is more disposable income out there. And with disposable incomes going up, there's going to be more spending, which means good for a lot of the consumer-facing businesses. Lower interest rates essentially are going to continue to give a push to infrastructure with tailwinds of a lot of government policies, government reforms. So again, the capex space looks also very attractive, especially the whole theme around decarbonization. So far, India has been more around demographics. Off late, it has been also around digitization. We now have the third D coming in, which is decarbonization. That itself is essentially going to unveil a huge, huge capex cycle in India. So across the board, I clearly believe that this correction is not an adversity, it's only an opportunity.
Nilesh, the entire consumer spending binge which we're talking about could get punctured if interest rates go higher, if inflation comes back. We could be going through this dangerous patch where growth is getting challenged and inflation gets stubborn, which means a rate hike. And then the reversal starts. Isn't that the biggest risk?
That's more, I would say, more a source of volatility rather than essentially the genesis of risk. Clearly believe that yes, interest rates could inch up. They could inch up by 25 bips, 50 bips, but don't see a material rate hike happening out here in India. And I probably think that's also the case globally. Still, clearly, if you look at it, policymakers still believe that low interest rates is essentially the way forward. That's the way to kind of bring about the buoyancy. In India, thankfully, we are not yet so much a leveraged economy, and Indian households and Indian families are not yet so much leveraged. And if there are interest rates, for example, today on home loans, the interest rates are at 6.5, 6.75. They could go up to 7.25. But will that essentially deter an individual or a family from going in for a home loan to buy the next house? Don't think so. So clearly believe, and then in addition to that, I still believe, the revenge shopping, the revenge travel, the pent-up demand, that still exists. So I don't see a material kind of a risk to the overall business environment with a moderate rate hike. I mean, still believe that if at all there's going to be a rate hike, it's going to be a bit moderate, and we are going to continue to enjoy an environment of lower interest rates and strong liquidity.
Good morning, Nilesh. So you're basically saying the unlocked trade may stay safe as far as the revenge shopping, revenge travel, revenge dine out goes. The last time you were here on ET Now, you also said have a leap of faith, start owning platform companies. Since then, Nilesh, a lot has happened, whether, it is the run up in the IRCTC stock, which has corrected. We've seen what's happened with the Paytm IPO as well. Do you still stand with that view, and how would you approach that?
Yeah, absolutely. I mean, still continue to believe that digitization continues to be the biggest theme or the most powerful theme. It's played out very well in rest of the world markets, including big economies like US and China. It's something which is going to play out even in India. It has started to play out, but it's still believe that these are early days. This is just the start. Having said that, Tara, one has to basically keep in mind that how tolerant are public markets going to be to these companies reporting losses, the big companies reporting losses. I believe that the next couple of quarters are going to be very, very interesting. That would public markets continue to basically in a way be supportive of loss-making platforms. The good thing today is that there's a lot of choice amongst the platform companies, amongst the digital companies, among the new age businesses. And there are a set of companies which are profitable, and there are a set of companies which are loss-making. We so far are still betting only on the profit-making companies which are essentially generating cash flows to fund their growth. So we are still backing those kind of companies. We're not yet investing into companies which are still continuing to make losses. But who knows? The space is getting interesting. And one thought here is that all these companies, they talk about a huge TAM, a total addressable market. I think that we as investors, apart from TAM, need to also look at the MAT, which is basically margins after transactions, money after transactions. That are they having margins? Are they generating money after those transacting users are coming on board? So these are essentially, so it's going to be a nice, interesting tussle between the TAM and the MAT. And that's what we need to watch out for.
You do own ICICI Lombard, so would love to ask you your views when it comes to the Star Health IPO. Are you going to look at that? What are you advising your clients? What are your views?
Well, we own ICICI Lombard. We've been owning it for a while, and it's been a very, very interesting kind of a play. We continue to like what ICICI Lombard is doing, especially in the general health insurance space. Continues to be the largest player, almost about 8% market share, and very well obsessed with its return on equity targets of about 20% plus. So we really continue to like ICICI Lombard. Star Health Insurance, again, is a very, very interesting place. We're very constructive on health insurance. And like the fact that Star Health Insurance has been a leader in that space, it's been growing at a frantic pace. And obviously, of course, health insurance continues to be relatively more underpenetrated. So we clearly like that space. Just that the valuations, seem to be on the higher side. And so therefore, one would probably want to wait for some time before one really invests into Star Health Insurance. Honestly, don't know when that opportunity comes up. But I think I've seen in generally over the years that even some of these fresh listings, post the listing, they do give you an opportunity to get in at a later stage, either when the market corrects or when that specific company is having a bad quarter. That itself creates an opportunity for you to invest. So maybe it's better to wait out for that. But otherwise, on the whole, I think Star Health Insurance is a great business. And it's a space to watch out for somebody who's really constructive for the long term.
Nilesh, just in addition to that, the last we spoke, you spoke about two large companies within the pharma universe in your portfolio, that's Cipla and DRL. Have you added any of the healthcare services to that pack? I mean, we've seen off late as to how Apollo hospitals, now with this new COVID variant, suddenly the diagnostic stocks are doing very well. Is that an addition to your portfolio by any chance?
Not yet. No, we don't own that. We still continue to like the frontline pharma companies. We still believe that the next couple of years could be very exciting for them, given the kind of launches that they have in regulated markets like the United States. So we continue to like the large pharma companies out there. We don't own any of the diagnostic companies, but yes, we're keenly awaiting the PharmEasy IPO. We think that's going to be an interesting space, given that PharmEasy also owns Thyrocare, which is a diagnostic company. And in addition to that, of course, it's an online pharmacy. Today, there are media reports that they're also planning to kind of be omni-channel and starting to open stores. So we wait out for that, for the PharmEasy IPO. We like in general the online pharmacy space. We think it's a huge market and is basically all set for being disrupted by some of these online players out there. So that's a more interesting space versus essentially the standalone diagnostic companies.
Sure. Interesting take there. The other thing I wanted to, ask about, Nilesh, is, while we've fallen 8% on the index alone from the October highs, the pain in some of the individual names, of course, has been much more drastic. Have you anywhere in the last month or so, or month to date, trimmed positions?
Yes, so we have trimmed positions. So we've in a way exited a position called Triveni Turbines, which we had bought a few months back, and that had a ferocious run up. Pretty much our fair value basically came into the price. So we've exited Triveni Turbines. There are a couple of more positions where we have been trimming our holdings and holding some cash and looking at an opportunity like this to basically put that money to work. So it's been an interesting time. We have exited positions and we've been also trimming a few positions.
Just to establish that today there is so far no follow-up selling at higher levels. If the Fridays and selling and Monday's volatility was largely on account of the new discovered virus, then this market got a reason to correct. And typically in a bull market, a 10% correction is a decent correction. A 15% correction is a sizable correction, and a 20% correction is a great entry point. And in individual stocks, that has kicked in. I was just looking at data which Jayesh has sent on Tata Group of companies, and the average correction there is in double digit in all the Tata Group companies, including TCS. Nilesh, it goes back to the leadership role what Chandra is doing. We've spoken about this, that how he's trying to reinvent and reboot some of the Tata Group of companies. But purely as an outsider, do you think Tata Group of companies, whether it is Tata Power or Tata Motors, or whether it is Tata Steel or for that matter TCS, I'm comparing different businesses here, but in terms of the P perception change which has happened, do you think that is over?
First of all, Nikunj, I must, commend you and the team at ET now. I think that you guys have essentially been really covering and covering the Tata Group really well. And I think that's been a huge service to investors. So congratulations on that. And in a way, the group has really played out. And Nikunj, the way it looks like is that if you're optimistic on any space, and if there's a Tata there, I think it's best to basically ride on the Tata name in that specific space. And honestly, we've benefited hugely out of that. We've essentially, in the past, we've invested in Tata Elxsi. That played out really well. We, of course, no longer own it. So that's played out really well. But in general, yes, I tend to think that by and large, a lot of the P re-rating has happened there. When I look at companies like Tata Consumer, when I look at a bit like TCS, when I look at Tata Elxsi now, clearly there is no now significant potential, or as investors, one cannot bet now on further PE expansion from these kind of levels. The stock that we like the most now in Tata Group essentially is Tata Motors. Clearly believe that that's only the start of the story. And clearly believe that over the next few years, Tata Motors will kind of play out quite significantly. They seem to essentially having all the pieces or which are firing well or are expected to fire well, be it an expected uptick in the CV cycle or be it essentially a huge breakthrough on the EV space. I think they really seem to have got the best of both worlds. Don't believe that the stock price at current levels factors in the future potential. So in the entire Tata Group pack, there's one stock which we like the most today is Tata Motors, and we own this in our multi-cap PMS as well.
Bullish on the EV re-rating, because if you are, then the stock already has moved up from 350 to 550 after that deal which happened in the EV business, which valued the EV business at $10 billion. So what could be the next trigger? Because that business already is now getting valued at $10 billion and the stock has reacted.
Yeah, for a market like as huge as India, and for somebody who's a pioneer like the Tatas, if the EV strategy plays out really well, and keep in mind globally, actually the EV space has really played out well in the four-wheeler, the passenger car segment, and that's exactly where they're going to be. Of course, in India, it's been a bit different so far that we hear more noises on the EV two-wheeler space. But clearly, it looks like is that the Tatas have clearly got a huge edge or a first mover advantage on the EV passenger car cycle. So clearly believe that $10 billion is just the start. Keep in mind that they've talked about that space being profitable and cash flow generative after the first 2 or 3 years. That to me is phenomenal. So that's one. Two is the conventional passenger car businesses where they have been gaining market share at the cost of the other leaders. And if that sustains and if that continues, then that business, which was honestly an overhang on the Tata Motors stock, essentially is going to now actually act as a huge tailwind to the stock. And the third piece, of course, is the expected uptick in the CV cycle. The CV cycle has pretty much been moribund over the last 2-3 years. And that's something which is expected to revive over the next 2-3 years. If you're going to have so much of manufacturing, mining, infrastructure related activity, then you're going to see essentially the demand for CVs come back, and out there, who's the market leader? It's Tata Motors. So clearly, I believe that these three pillars, which is essentially the CVs, the conventional PVs, and the expected EVs, all three put together, to me, are essentially pretty strong tailwinds for the Tata Motors stock to basically, in a way, not just re-rate, but also kind of move up based on a huge growth in earnings as well.
Nilesh, just staying with the auto pack, where you said your top pick is Tata Motors. What about M&M? Because of late, we've seen it at M&M also, where there's new launches. I'm not going by the 7-month, 8-month long wait list, because that might be due to the global supply disruptions. But there's been a lot of chatter about innovations that's taking place at M&M.
Oh, yeah, absolutely. M&M is essentially the great proxy of course correction. What they have achieved over the last year or year and a half, I think is phenomenal, where they've essentially in a way exited, or as we say in our parlance, they've had a stop loss to various loss-making businesses. So that's been the first great step. Two, of course, is tractors, farm equipment essentially as a space has done well and expected to continue to do well. On the whole, clearly believe that again, M&M is again a great kind of an investment. I believe over the next years, it has a strong potential to kind of outperform. And by the way, we own M&M as well. So we own both Tata Motors and M&M. Both we believe are two very independent segments, and therefore, in a way, gives us a very holistic and a comprehensive exposure to the entire four-wheeler space in automobiles. So we really like that space, and we like M&M as well.
Okay, so in the auto pack, Tata Motors, the clear favorite, and you've also got Envision that likes M&M. Nilesh, it's always a pleasure talking to you. Thanks so much for joining us live today on the market. Lots of headlines there, ladies and gentlemen, whether it's from the insurance sector, the views on Star Health IPO that's coming in, platform companies, and of course, auto and pharmaceuticals. Let's take a short